After getting whittled down and weakened for years, the estate tax makes a comeback in the latest House plan. Robert Frank joins us now with more. Robert, good morning.
Good morning, Joe. Fewer than 2,000 people actually paid estate taxes in 2020, only raised about $16 billion in revenue. That's down 50% from a year ago. Now, the main reason is the exemption, which is now $11.7 million per person. That means estates worth less than that go untaxed. But it's also because the estate planning industry has found and created massive loopholes. The House now aiming to close those. The House plan would cut the exemption by more than half to $6 million. It also effectively ends what are called grantor trusts. These have become kind of this secret sauce for estate plans. They allow business owners to create a trust that they own and control, but is separate from the estate for tax purposes. The House plan would force new trusts to be part of the estate. Now, for the investors, the most important change to the estate tax proposed is the so-called discount planning. Now, this allows investors to place a portfolio of stocks or financial assets into a partnership. They can then gift it out in pieces to family members. Each piece then gets discounted for tax purposes by up to a third because it is a non-controlling stake. Now, the IRS, not surprisingly, has tried for years to challenge this. The House plan would finally ban it. Now, the Tax Foundation saying all these changes together would raise an additional $65 billion over the first 4 years. Joe?
I was listening closely. The second to die insurance, whole life insurance, that's not affected here. That's not something that seems like you're sort of making an investment long term that just builds up a certain cash balance to help pay for estate taxes. So that's not a loophole per se. That's just preparation, is it not?
Right, but there are changes in this, and they're far too complicated to get into, but there are changes in the House plan to the whole life insurance application to estate planning. And remember, this is all sort of in lieu of the president's plan. The president wanted to get rid of the step-up in basis and tax appreciated gains upon death. The House did not include that. So because of that, and for revenue and sort of progressive politics reasons, they had to include something. So the president didn't really touch the estate tax. The House then had to beef it up. And that's why, the insurance loophole, GRATs, all these trusts that have been sort of a key part of estate planning for years are now sort of under pressure. We'll see where the Senate comes out and whether any of this actually happens.
Shepard Smith here. Thanks for watching CNBC on YouTube.